Jobs are hot, hot, hot. We got the January jobs report this morning, nearly triple the amount of jobs created as Wall Street had expected. The Federal Reserve did raise rates this week 0.25% as expected. I'm going to venture and say it was the most useless, meaningless 0.25% raise in the history of the Federal Reserve. As predicted last week on this show, mortgage rates did fall after the Federal Reserve raised rates, as they simply don't believe them anymore. And it continues to be the case. The most dangerous thing in the real estate market is bad pre-approval letters written by weak mortgage bankers and brokers that essentially not only don't respect themselves, but don't respect anybody else's time at this point. Welcome back to This Week in Mortgage, everybody. My name is Sam Battaglia, your favorite mortgage broker here in California at Guaranteed Rate in Beverly Hills. Hope you had a great week. All right, well, we got the January jobs report. Blowout number, I'm willing to say that, way hotter than expected, nearly triple what Wall Street had expected. And we actually had some wage growth to go along with that, which to me signals more career jobs coming online than just jobs. And my measurement for that is wage growth. So actually, this January jobs report did look good. When a few weeks ago I thought we'd have a tough jobs market this year, this was a very pleasant surprise. Some funny things about the jobs market. Layoffs definitely continue, so we'll see how these numbers meet up at some point. And a couple notes here. So the stock market is not the real economy, and today's going to prove that out. After a blowout jobs number like this, if the stock market had anything to do with the real economy, the Dow probably would have been up 1,000 points today. Instead, it was negative. The reason for that is the stock market does not want a strong economy because the stock market's been living in the era of easy money for the last decade or so. And a good economy means that the Federal Reserve continues to take the punch bowl away. So stocks do not like a good economy, and stock market also loves when people lose their jobs because they're trusting that the companies they're betting on are going to be able to fill that vacuum with the workers that are remaining and essentially boost up the earnings per share because they have less stuff to pay out, less payroll and wages to pay out every month. So less jobs, more earnings per share. Wall Street loves when people lose their jobs. Wall Street loves when the economy is weak because they love the easy money era that the Federal Reserve put us into. And of course, job loss at some point could happen, and that might have the Federal Reserve get off the fence and bring a little bit of that punch bowl back. Moving on to the Federal Reserve themselves, tone and tenor has definitely changed this week. They used the word deflation a bunch of times, which they have not said that word in a very long time. But they did raise 0.25%. That made absolutely zero difference. And my prediction that I had a few weeks ago, we are going to start cutting. The Federal Reserve will start cutting rates by the end of this year because, as I always say, in order to cut rates, you got to raise rates first. And I think that's still what's happening here. Moving on to mortgage rates, tone and tenor definitely shifted along with the Federal Reserve's tone and tenor this week. Again, as I predicted last week, after the Fed raised rates, mortgage rates will go down, and they did. Simply, the bond market, the mortgage-backed security market, does not believe the Federal Reserve at this point. The Federal Reserve has no reason to keep raising rates. At this point, it's really literally meaningless because they're going to start cutting sooner rather than later. But they can do what they want to do because eventually they're going to have to start cutting again. 10-year Treasury, which is what mortgage rates follow pretty darn close, 350, still at that 350 pivot point. And things seem to be settling down. We got down to 336 actually after the Federal Reserve raised rates on Wednesday, and then today after the blowout jobs number, we headed back above 350. And I think we closed a hair above 350 when it was all said and done. And the longer this stays very tightly range bound at the lower end of the range that we've been in, the more mortgage rates will naturally come down because a risk layer of pricing will come out of that, and that risk layer is essentially uncertainty that if a bank funds a loan, that'll be on their books in 6 months because rates went up so far so fast, they're worried about runoff on their book and everybody refinancing. So we should continue to head down on the 10-year Treasury as the year goes. I think we're going to close the year around 250. We'll see how we do there. And as I said before, when it comes to mortgage rates, I think this is just going to be a big round trip back to about the February of 2020. And about within this year, I think we're going to make a round trip to where rates were pre what we dealt with for the last 2 years. And that should set up for a really healthy real estate market. All right, moving on to the most dangerous thing in real estate, the biggest time waster in the world is a bad pre-approval letter. Now, this is a pet peeve to me because being in the business and being somebody who quotes clients and writes pre-approval letters, I like to do a thorough job at it because I don't want to waste anyone's time, most certainly not my own time. But this week, I received 3 calls from listing agents on the day that the contingencies were supposed to be lifted, and they asked me to take a look at the files and see if I could help out. This is a little bit insane because 2 of these pre-approvals that weren't worth the paper they're printed on came from big bank institutions that if you left your house today, you definitely drove by a few of their branches. And the reason I say it's insane is if you work at a bank, you have one set of guidelines. You don't have 2. You have one set of guidelines, a few different products, but one set of basic guidelines that you're going to be following. So if you work at a bank and you write a pre-approval letter and it comes to be uncovered that the client does not only qualify for what you wrote, doesn't qualify for anything in your program set, what are you doing? Honestly, what are you doing? And it's really embarrassing. And one of these banks was actually the private wealth department of the bank that wrote their client who had millions of dollars of pre-approval. I don't know what they were looking at. So I am perplexed. I don't understand. It's 2023. We've gone through a lot in the mortgage business in the last 15 years. And I would figure if you're still doing this at this point, you know how to qualify a client for a pre-approval. But I guess some people don't. And I'm going to take that back to weak and desperate mortgage bankers and brokers that simply want to get a deal in the door and clearly don't care about their reputation and clearly don't respect anyone's time, especially their own. So I don't know what to say, but these bad pre-approval letters are just gross at this point. And here's a little tip to my realtor friends that are the listing agents and the buyer's agent for that matter. If someone, a mortgage broker, mortgage banker, gives you a pre-approval letter in 10 minutes, and that person that they wrote the pre-approval letter for isn't on a simple W-2, having a couple bank accounts, having enough in the post-closing reserves. If you go online and check the value of their house, that they've got enough equity or that they're putting enough equity down on the down payment on the purchase. If somebody can give you a pre-approval in 10 minutes or less, I can't make a turkey sandwich in less than 10 minutes. I don't know how somebody can write a pre-approval for a mortgage for $3 million in less than 10 minutes. So if somebody writes you a pre-approval letter in 10 minutes and is a yes person and wants to make you happy so you send them the next one, but in reality they're weak and they're desperate and all they're going to do is upset the person they're writing these pre-approvals for, I just don't understand. I'm very perplexed. It's 2023. If you're in the mortgage business, you need to learn how to write a pre-approval letter because my realtor friends that are out there hustling every single day, I see how hard they work. They've got to drive clients around in their cars. They've got to go visit them at birthday parties. They've got to do every single thing to service their client. And then you come along and write a bad pre-approval letter and you waste everybody's time. My advice, respect yourself, respect the game. And my agents, please, if somebody gets you a pre-approval letter in 10 minutes, ask about a few questions to make sure this person is not just blowing smoke at you. All right, everybody, that is my show for this week. I hope you enjoyed it. As always, if you have any mortgage or real estate related questions, please don't hesitate to reach out to me. It's Friday again. It's a weekend. Please enjoy yourself. Be safe. Take care of others. Be kind. Be a decent person, of course. And thank you as always for watching. Have a great weekend.